Financial Thing Studios is the Peer-to-Peer Lending Essentials podcast.
Welcome to the Financial Thing Investing Essentials podcast. My name is Lawrence Samuels. I'm your host as always. I have a special guest today. His name is Fred Bristol. He is from a company named Brickowner, which is a company I'm personally not that familiar with, but I'm excited to learn more about what Fred is doing with Brickowner and what Brickowner is all about. Again, disclaimer, I do not invest through Brickowner presently. Who knows, that could change in the future once I learn a little bit more about Brickowner. But coming direct from London today is Fred. How are you today?
Yeah, really good, Lawrence. So thanks for making the time to speak, and I look forward to giving you much more information and background on Brickowner, where we are, where we came from, and where we're going.
It'll be a good chance for you to sell me on Brickowner. A potential investor, you
Definitely,
never know.
Yeah.
You know, me and my millions of pounds that are in my bank account. I'm kidding. I don't have millions. Okay, so to start out with, Fred, you know, I'm a person that likes jokes, right? You listened to my podcast before, so I'm going to give you one here.
Yeah.
Are you ready? Okay. Why do bankers make good lovers?
I don't know. Try to think of that one.
Because they understand the penalty for late withdrawal.
Good, yeah. Better than some of my jokes.
Okay, not my best work. Okay, Fred, go.
What, my joke, or?
Yeah.
Yours is a lot better than mine. What did number 7 say to number 8?
I have no idea.
Nice belt.
Nice belt.
It looks like a belt. So honestly, a lot of my jokes are probably more inappropriate for this type of podcast.
Nice belt. I didn't get that one.
Hey.
Never mind. I'll figure it out later, I guess. Nice belt.
I tried it on my girlfriend actually, and she's actually from the US, and she didn't get it, so it's kind of lost in translation, I think. Yeah.
But I'm an Englishman. I should get it, right?
Yeah. I don't know.
Hey, I wanted to tell you that you're actually the first person named Fred that I've ever interviewed. You just don't see that name now. It used to be a very popular name, and so I started researching on the internet all the people that were named Fred who are famous. And guess who the number one person who was being listed as the most famous Fred?
Fred Trump?
No, it wasn't Fred Trump. It was actually Fred Savage from the Wonder Years.
I don't believe this.
That is random, yeah.
He was the most famous, but I was thinking, like, Fred is a really versatile name because you could use it to be regal, like you got Fred, the King of Prussia, and then you could also use it to be very intimidating, like Freddy Krueger, for instance, who was kind of an intimidating, even though it wasn't really his name. And then you could be artistic. You've got Freddie Mercury. So it's really one of those names. You're very lucky to have a name like Fred because you could use it in a very distinguished way, or you could use it in a very intimidating way. So I like that name. I think it's a good, strong name. Yeah,
it's good. As you said, I'm English, but it's actually originally it's a German name.
Oh, okay. And did you know that Freddie Mercury's name was not really Freddie Mercury?
I did, and someone told me his real name, and I can't remember it.
No, it's some strange, like Farakouche or...
Yeah.
Anyway, moving on. So let's talk about you a little bit, Fred. Where are you from?
So I'm English, I'm from London, and I've been doing property. So my background actually is not tech, it's property. So I've been doing real estate for the last, 14 odd years. And I started off in Eastern Europe, working in a number of different countries for about 5 or 6 years, managing real estate over there. And that was the first time that I experienced, so we're managing a small fund, and I experienced the hassle of onboarding investors, and that was way before all the kind of more rigorous, I'd say, KYC, AML issues that we face today. And even then, it was I guess I wouldn't say a nightmare, but in terms of admin, but it made it unviable to accept smaller increments of money. So we never accepted less than, I can't remember, 25 or 50,000 pounds even. And then so that instilled in me, fun enough, just I guess the kind of basis of how it was hard for people to hard for normal individuals to access some of the most interesting opportunities, because these barriers to entry, which were from the kind of investment amount they had to have to make it viable for the asset manager to accept their money. So that was kind of the thing that got instilled in me quite some time ago now. And then I was working in the UK for about 6 years in like a number of regions. Well, we're English, so East Anglia and Lincolnshire. And mainly doing residential, a bit of planning, and this is where the kind of idea for Brickowner came from, actually. So probably going back now to probably early 2015, call it January, February, I was looking at a particular town in Lincolnshire, and I was looking at buying myself. I already owned some things there, so buying more residential, because at the time you could buy. It was very interesting from a investor's point of view, because you could buy. There's a housing shortage in the UK, so you could buy below new build costs. You could buy at £110 a square foot, which, when you factor in the cost of land, it was basically below. Or I mean, you probably could. It was just on par or below. And these were very nice Victorian cottages. There was a strong rental demand, but the numbers are very small. So these houses typically go for 80, or anything from actually 70 to £90,000. So I thought then it'd be interesting to work with a number of investors to kind of do it on scale. And then in my mind, there are kind of three different types of investors. There's big institutions who wouldn't need anyone else because they're doing it themselves. And then there's, I'd say in the UK, there are like 2 million buy-to-let investors in the UK at the moment. And technically, I'd say anyone who's the middle ground, if there were three different types of investors, was the institutions, then the buy-to-let investors who might have anything from, I'd say, 4 to 40 properties. And then there's people who, they're not necessarily retail investors, but they're people that wish to invest smaller increments of money, or they want to invest over time and can drip feed money in. And that's when I realized actually the opportunity was really kind of the real demand from investment perspective was the people that were unable, a bit like what I'd faced some time earlier. They didn't have enough, or they couldn't justify the kind of investment of 25 or 50,000. So those were the people then that I thought had the kind of need for the product, for this kind of product. And then I spoke to a friend of mine called Toby, who I used to work with a very long time ago, and had been running a tech accelerator in Berlin for about 5 or 6 years. And then together we kind of, that takes us to about March or April 2015, and that was kind of the basis of the beginnings of Brickowner, really. It's kind of honing the business. And to begin with, we were very much looking mainly at residential. We were looking mainly in these particular regions, and as we honed our business model, we kind of shifted it to we looked at I guess, as you know, like in many things, from investment side, the US leads the way, and I'd say from my perspective, it definitely leads the way when it comes to alternative finance, and especially I'd say on the equity side for platforms, so for real estate platforms. So I'd say a platform such as Fundrise, I think, is very it was very interesting to look at where it had come from, how it had grown, and then where it ended up. And what their model was very much, rather than, I'd say on the equity side, there are, going very high level, there are kind of two main models. One model is you can focus on being one model is you can be a platform, and if you've got a secondary market and exchange, but also you are selecting and managing your own properties kind of in-house, as it were. And there's a platform in the UK, Property Partner, you know them, but they do they do that. So they're very much, I'd say they're actually in my mind, they're two businesses in one wrapper. So they're a tech platform and exchange, but they actually go and source all their own properties, and obviously they subcontract lots of ours, but fundamentally they rely on their own in-house expertise to judge the people that are then changing the light bulbs. And that kind of model has a lot of issues. It's good in many respects, but has a lot of issues as well, which is I'd say the primary ones when I looking at it was firstly the underwriting. So you need an enormous facility to underwrite your properties, because as you're finding different properties, you've got this issue of how do you secure the asset to then fund it on the platform. And then the second issue is, as you know, there's often, you need to know an area very, very well. So there's often, you might have one street and another street parallel or a 5-minute walk, but maybe the capital values are completely different, but maybe they're the same, but maybe then the rental demand for each street is very different. So you need all this very detailed expertise. So for kind of a pan-UK business, I think that's very, very hard. You have all these hurdles, so it's very hard to do in-house. So that kind of put us off. And then the other thing that put us off going down that model was the fact that I wanted the ability to not only do residential. So as you know, for every sector you do, you need greater and greater amounts of in-house expertise. So that was one model. And then the second model, which is I'd say the biggest one in the US, is one where you focus really on being a platform and the tech, almost like a facilitator or an aggregator, and you're selecting, so your due diligence process is twofold. Rather than, so the assets sits behind, you're actually selecting the property asset manager first, and then the deals come from them. And then these are the asset managers who I was one a while ago, as I mentioned. Their minimum, and then the minimum they'll accept might be 25,000, it might be 50, could be 250,000 pounds. But they actually are sourcing. So the people we're looking at are minimum. Some of them might manage as little as 40 million, and they actually go up to £1 billion. But the thing they all have in common is they raise equity on a deal-by-deal basis, using a number of different investors. So we work with those types of people, and we actually aggregate for them. Our minimum is £100. Their minimum, as I said, can be 50, 100,000. So we aggregate for them, and so in effect, we're solving, I believe, two problems in one: the problem of the end user not being able to access these opportunities and the expertise, and then we're solving an issue for the asset manager, which is we're giving them, firstly, a greater access to capital, which they wouldn't otherwise have, and a pool of capital, because obviously there are many, many more people in the UK that can invest less than 50,000 than there are that can invest over. And these people grow as investors. So, as I said, so not everyone, even if someone over a 5-year period can invest 100,000, they might not be able to do it all in one go. They can drip feed it. And a lot of these, so we're going to launch a secondary market as well. So a lot of these asset managers are lacking, obviously real estate lacks, it's illiquid. So that's our model, and that's kind of where we came from and where we're heading, really.
Do you personally invest in peer-to-peer lending or crowdfunding in other companies yourself, or not?
I invest in lending platform. Well, I use RateSetter. And I've actually used it on both. It's interesting. I've used it on both sides of the platform as well, both as a lender and as a borrower. And on the equity side, as I said, like I because my background is property anyway, like I own different assets, so I've tried out a number of platforms more out of interest than anything on the equity side than anything else. So I guess from my perspective, because I already own property, so I'm exposed on the equity side, it's more interesting on the debt side for me in terms of using platforms.
Is Brickowner, I presume, is only open to people UK residents?
No, so we are actually open to, technically anyone that can get through our KYC AML process, but the caveat there is we're not today open to US investors, so they can't actually, they're not able to even to sign up properly.
No, I understand. Yeah, most of the companies don't. For some reason, the American government has decided that it's not good for American people to be able to spread their wings over to different countries because of the terrorism and money laundering issue that the Americans seem to be fighting, which is a shame. Explain to me briefly about the process of how you choose which properties you're going to offer to the people on Brickowner.
Yeah, so as I said, so our process is a little bit different because before we even look at a property, we will look at the asset managers. So what we're trying to do is build a I use the analogy like a sausage machine, I guess. So when you're working with a number of asset managers, it could be a large number, it could be a small number, but what we don't want to be doing ideally is doing one-off deals or investing in one-off deals with lots of different managers. We want to be working with these managers and doing multiple deals with them. So once we're happy and we've got a relationship with a particular manager, then obviously they do a number of different deals a year. And then we'll be offered these opportunities, and then we decide whether there's no obligation to do any of them, but we're likely to do a number of them. So for example, one of our managers does they do 4 deals a year, and they raise 10 to 15 of equity for each deal, and I wouldn't be surprised if we end up doing 2 of their deals a year, but it'd be unlikely if we did all of them, but you never know. So I guess, so that's on the manager side, and then looking at the assets and why we are choosing to go into some and not others. We're a very new platform, so we've just launched a few months ago, at the beginning of the year really. So we're really focusing on, so if you go very high level, I would say, why do people invest in property? They invest for income and for capital growth. That's what it really comes down to. So obviously some investments can be a mixture of both. Initially, our view is that we're focusing more on income producing. In terms of capital growth, we don't like. So don't think we'd ever do really is invest on a speculative basis, meaning the market is going to go up. Let's invest at today's value and cross our fingers and it all should be okay. We're not doing that. It's just, so on the capital growth side, it would only be where there are value add deals, where you're actively adding value, which will generally obviously be through development or through, if it's a yielding asset, through what kind of playing around with the tenant mix. But on so we're initially focusing on income because I think there's a huge demand. Obviously, it's very hard for people to get income at the moment. And also as an early stage platform, I think it gives comfort to new investors once they start receiving their dividends. So I think, which is obviously why the lending platforms in a way are lucky, because you obviously get like very regular distributions. So we're very much focusing on that at the moment.
You speaking about asset managers, so these asset managers already own these properties and they're offering you to be a part of that deal, or are they properties that they're considering purchasing? Because I'm wondering, how does it work if you're unable to raise enough funds to get into a deal? How does that work?
So going back to the issue, I would say, with if you're 2 businesses in one and the underwriting. So we're working with asset managers who are already underwriting so it'll generally be new deals. So they would have secured them, and they would have underwritten them as well. And then they're basically syndicating it out, but at value, so there's no value shift, if that makes sense. Okay. So, but they'll be then new investments. So then.
Okay. So you're able to, if you cannot raise enough funds on a particular deal, you're not under any obligation to move forward on that type of deal when it's through an asset manager. Is that correct?
But so we're speaking to one asset manager actually, so in a good way. That's why we want to work with a number of asset managers and do repeat business with those same asset managers, because every deal is always a little bit different, because they all have, you're going in, if you're a minor investor, you're going in on basically on their terms. So So far, all the asset managers we're speaking to, we have no obligation to complete the investment, and they underwrite everything. But we are in discussions with others where that could change, and then we would look at, there would be small penalties, meaning, which we would we would cover, not our investors. Tiny penalties, kind of 2% of your raise type stuff, but just enough to kind of matter.
Since these properties are not sourced by yourself, I presume there's the same amount of due diligence that has to go into choosing which one is correct, or which investment is okay. Would I be correct in saying that?
Yeah, you would be correct in saying that, yeah. But in a good way, obviously, because they've got other investors coming in alongside us, they've had to all produce for everyone independent, arm's length, red book valuations and everything else as everyone comes in.
Okay, and so you're a part of an investment, sort of a group in many ways. Is this held inside of an SPV where...
Yeah, it is, exactly.
Sort of like another layer to what standard equity property companies do, whereas they bring the investors in, put them inside an SPV, and now you're Brickowner inside of an SPV, and then the investors through Brickowner are just... I guess I'm having a little trouble understanding how that setup is legally put together. Like, do the investors have a separate agreement with Brickowner, and then Brickowner is the SPV?
Yeah. So we have so every investment that we invest into, we will set up our own SPV for. So Brickowner SPV. So just say, easy numbers. Just say we have 100 investors putting in £1,000 each into an opportunity that requires £1 million. Our 100 investors would go into a Brickowner SPV, and that would make £100,000, and that money would go into the kind of master SPV, which alongside another 900,000.
As far as the decision-making processes go, once you're inside of that SPV with other investors, how do you have any power as to what happens with that property? I'm just thinking, to me it seems like you'd kind of be at the mercy of what the asset manager decides how they want to control that property.
Yeah, you are. So what we're doing is we're offering people the ability to invest into something they couldn't otherwise invest into. We're not advising them to invest into something, so we're giving them all the information, all the kind of the timeline, the terms. But we would have the same. Our SPV would Brickowner SPV would have the same rights as all the other equity alongside it.
I'm just trying to understand how that works, because it's a bit of an unusual setup compared to the way I'm familiar with the other companies who offer equity shares in property. So what is some of the sizes of you said 10 to 15, you're talking about million, I would imagine, correct?
Yeah.
Not thousands.
No, sure.
Okay.
So I think, to be honest, they're all a bit different. If I look at what we're looking at, some of them actually are. Yeah, some of them are. The biggest we've been looking at, which actually we could not invest into because it was available before we launched. But there they were. The investment was forward funding 4 new travel lodges on 25-year leases, and that was, I think, 50. 12. I can't remember. It was like 12 million equity raised for it. But we could have gone into that. We didn't. But then on the other extreme, the kind of small extreme, so we could still do things where we would, our SPV could own all of the equity necessary for a particular deal. It's just obviously on the bigger types of deals, we at the moment we don't have that kind of liquidity through the platform to do that.
Sure.
But on the small scale, we're looking at things, some HMOs where, basically what are the houses where you might have 5 people, but you clean them up, make them look good, and you might have 5 people living there, but you're doing that on as I said, more of a sausage machine. So there'll be different investors for each different house, but they're obviously small lot sizes. So it's kind of a mix, really.
You're a newer platform. You said you just launched at the beginning of 2017. So this question I don't know how much weight one would put into this, but I was just wondering, what's the kind of average investment amount that investors are putting into Brickowner? What's your current average approximately?
Our minimum investment is £100, but obviously we don't want lots of people putting in £100. So it's more, we have a low minimum purely because it gives people the ability to test, see if they like it with a small amount of money. But I'd say our average at the moment is around 1,200. The largest amount is so far from a single investor been around £10,000. But I expect it's looking at kind of how it works with other platforms. We are aiming to grow two different things. So one is our user base and also the average amount each user is investing. We expect that to increase.
Yeah, obviously you're new, so those numbers are going to be smaller at the beginning, which is okay. Also, another question: how many investors do you have right now, currently today?
End users using our platform.
Yeah.
Yes, we've got we've only done two deals. So in those two deals, we've got top of my head 78 people invested in them.
Okay. So you're going to be rapidly growing, I think, soon. You'll have more.
Yeah, we're already growing. I mean, we're growing quite a lot. So we're growing. Our user base is growing probably 20% a month.
Yeah. I find it very interesting that it's good to speak to somebody that's running a newer company, because a lot of the times I'm talking to the ones that are more established, and it's nice to get a different perspective of watching a company grow from the small roots and hopefully become bigger. So
definitely,
that's good. Okay, well, great. So I talk a lot on the website about platform failure. It's one of the biggest problems that investors face. We're all worried about it. Importance of a company being profitable over a period of time is important, very important. When you start out, it's more difficult. We understand that. As far as Brickowner's profitability, how long will it take for you, do you think, to become a profitably operated company?
So we're aiming to be profitable within kind of 24 months. As you said, there's always I use the analogy, funny enough, of like where I want to be is, as you said, there's always a kind of dichotomy between profitability and growth, and you're kind of almost kind of, you're juggling each one. So where I think the best way of growing is from a profitable position, to be frank. That's a position of power. Actually, I remember recently someone used the expression that investors now were looking for. This is investors in businesses. They were looking for what are they called? What are those animals that they're looking for cockroaches as opposed to unicorns, i.e. cockroaches can survive in any kind of condition, whereas unicorns obviously don't even exist. So, but I think that's actually quite an interesting way of looking at it, which is, I think people, a bit like what you're talking about, it's less about, these kind of companies that will never make any money, or they might do, but at some crazy point in the future, and more about, trying to get to a break-even position, which is obviously a position of strength, and kind of growing from that point. So that's very much what we think. And again, I use the analogy of almost being, if you're a boat, and the shore is profitability. You always want the shore within your sight. So if the kind of weather gets bad, you can always make it to shore, if that makes sense as well.
It's all about risk too. I think it's a less risky way to try to achieve profitability first before trying to grow too quickly. But every company is different, and it sounds like you have a game plan to get to being a profitable company within 24 months, which is a good thing. One thing I will say is when you mentioned HMOs, I kind of cringed for a second, because I've been investing through Property Moose for a little while, and the HMO situation has been a bit of a rough one over there, as far as, because the management, they haven't been able to keep the occupancy in the HMOs up, and the investments have generally performed dividend-wise very, very poorly. What's your reasoning for wanting to look at something like that when HMO, knowing those types of things are going on?
Sure. So when I'm talking about HMOs, they are legally HMOs. But so we've, as I said, so rather than looking at the end property and saying I want to invest in HMOs, again, we've been talking to a particular manager who manages, at the moment, is specialised in the student sector. So they have, I think about 150 properties, and now they are moving into, and they make them very slick, and they've got a very good track record of 12 years. And now they're moving into kind of a young professional sector, which is they've got a very strong brand. It's very complementary to their brand, because at the moment all their tenants are university students, and obviously they then become young professionals who, by default, looking at the statistics in the UK, most of them definitely can't afford to buy, and most of them can't even, especially in kind of major cities, can't really afford to rent on their own. So because of what they've been doing already in HMOs for students, they've got a strong, very good brand. They've already got the tenant mix already lined up. So that was why we were interested in them in particular, and obviously they do HMOs. So we weren't interested in it as a standalone, but as with these particular managers and their track record.
So Fred, you mentioned we're talking about student housing. Seems to be a very popular trend for peer-to-peer companies offering student development projects. There's a lot of them around now. What are your feelings on those student development projects? You think that's a good place for somebody to be investing their money right now, or not?
I think, it's quite interesting actually, because we put a student property on our platform, and I like it. And before we did it, obviously I researched all the macro. So, and obviously with Brexit as well, because now it's all about, as Trump says, fake news or whatever. You never know what to believe. So it's quite interesting reading it, because I thought, because like a lot of foreign students in the UK, but actually, interestingly enough, I can't remember what it was, like European students were kind of number 4 in terms of foreign, and it was I think it was like Nigeria and India, and like places where I didn't really expect it to come from. I thought it would mainly be kind of European or German or something. So from that perspective, will what's going on affect, like in terms of Brexit, affect student housing and the demand? No. I also think it's quite interesting if you look at households and household expenditure cuts. Obviously, the first thing to go is holidays and whatever. I really want to have children at some point, but I don't have any children. But I know a lot of my friends do, and I think education for your children is one of the last things to go. So I think from that perspective, so it's all heading in terms of, and you've got a very strong tenant mix in the sense you've got, you've got a building with 100 different tenants where all their, parents are paying. You've got a strong tenant mix. So I like it, yeah.
I want to talk about the wind-up process if Brickowner for some reason were to fail. We have 2 layers of what's going on with Brickowner. You have the SPV that is a Brickowner SPV involved with an asset manager, and also possibly ones that you're sourcing yourself. So 2 questions. Firstly, if the asset manager company failed, what is the wind-up process for them, firstly? And then secondly, what is the wind-up process legally on Brickowner's end if Brickowner were to fail?
So if the asset manager, if you think about it, firstly, the asset manager as a business, so it's a bit like Brickowner, like our company, like the actual Brickowner Limited is not owning and buying the property, we're managing the property. So if we fail, it doesn't in that respect affect the underlying investment. You could replace us with another manager of the SPVs. So that's the first thing. So again, in a similar way to the actual kind of master SPV that owns the property, again, if that asset manager went bust, that would be different to the actual property, say, breaching covenants or being taken over by the bank or that going bust. So they're all a bit different. So I'd say the main thing that would affect and I'll get back to Brickowner, the main thing that would affect our structure in a negative way would be, so if which could happen anyway in any structure, if the underlying property breached some kind of it's always about lending, isn't it? Like lending covenants, then as always, like the bank would, firstly try and get its money back, and then whatever's left is distributed between the equity investors. But on that note, we don't we're not interested in investments with high leverage. So and at the moment we're not even doing development. So we're doing income plays, and we're not into. So even with the HMOs, we look at 50% LTV if we borrowed. Mm-hmm. So, and with strong income. So we like to think we're not taking we're not interested in taking big risks.
Is there a management third party put into place, beforehand in case a company fails? Like does I'm not very familiar with FCCA regulation rules as far as how that works, but I understand that in order to be regulated now, you do have to have a wind-up process, third-party trust in place to handle things that if a company failed. Is that the same for the asset manager? Did they have somebody in place in case they fail to manage that property?
They have. They do in the sense that, say, for example, at the moment, our regulation, we're a bit like property moves as well at the moment. So we're appointed representatives of for FCA purposes of a company called Gallium, and property moves, I think, at Sapia. Mm-hmm. But they would. that's why they're there. So if something happened with Brickowner Limited, then obviously Gallium are then kind of coming in. Yeah.
I understand. So that's the company that's in place in case the disastrous situation happened, which of course we hope it doesn't. But as investors, we always have to think about those things, worst case scenario situations. So it's good to know that is in place.
Sure.
I mentioned before that some of the properties on some of the other equity platforms have performed definitely more poorly than was advertised. There is a lot of speculation when it comes to, property investing. That's just part of the risk of what comes along with it. Have you found, I know it's early days for you, but have you found that your projections are in line with what's actually being realized as far as returns?
As you said, it is early days for us, but so far, the answer is yes. And again, what's interesting is we're investing with managers who have strong track records. So as I said, we look at their track records, and then we look at the property. So we wouldn't look at the property as a standalone of this is the projected return. We look at the manager and have they actually performed to deliver their projected returns over a period of time.
Okay, so that's probably a question I should be asking you in a year because it's very hard to tell. You're still very early in the game. But Fred, what is the single biggest challenge that Brickowner faces right now as a company?
I think, it's interesting. I think most companies in my space face the challenge of, firstly, credibility. Because although it's still a very new sector. People, and I think people it's trust really. So people inherently don't trust platforms or websites. So getting past that hurdle is big. It's a big thing. And with credibility and trust comes also, because it's such a young sector, like you could have one rogue outfit who kind of disproportionately could negatively affect the trust of other platforms, like from a contagion perspective. So I think that is bad as well. I'd say I would say they are big things, and I think, interesting enough, it's interesting because obviously they are very new sectors, and the FCA is almost catching up with the sector from a regulatory point of view. And I think it's I think it's a very good thing that it's all properly regulated, and I think in a really healthy way it'll mean that it's less likely that something will go wrong and there'll be contagion. But as long as it's all done, so far they seem to have done a very good job at doing it all, methodically and in the right way.
Yeah. So, Fred, regarding credibility, I find this very interesting. You're a new upstart company. There's obviously other players in this space that have been established for a while. How are you overcoming this problem of being credible, and how do you attract the customers, and where are your investors coming from?
Yeah, so what's interesting is if you look at our model compared to, you mentioned, say, Property Moose or a bunch of others, we are actually an aggregator and a facilitator for very established property asset managers with strong track records. So in a way, we can almost piggyback from a property asset management track record perspective. We're almost able to piggyback off other people. So I think in a good way, I think we're kind of ahead of the curve from that perspective. Whereas I think if we're all trying to do it in-house, it would be a lot harder as well.
Yeah.
So and your other question was to do with
your credibility. How are you overcoming the credibility issue of being a brand new company in a new space, and where are your investors actually coming from? Where are you finding these investors?
So the first question I think I've more or less answered, which is in terms of credibility and trust, we're almost trying to piggyback off our asset managers, and then where are we finding them? So far we haven't done any on purpose. We haven't done any PR at all. I'm surprised by how many of our investors. A lot of the investors, I'm sure you know, but they're all nearly all the platforms. I'd say 65 to 70% of all the investors are men, which is quite surprising. But of the P2P ones and the equity ones, we found the same. It's quite interesting. And again, we've been surprised by how many. Some of them you just don't really know where they came from, but a lot of them are come through referrals. So again, and we did studies and surveys on this as well, that people trust. And I know even the big platforms now, they say they grow. They call it word of mouth, but actually it began through referral schemes and getting your people to introduce people, and that's a proven way. So we're really looking at growing in that kind of way, because that also gets rid of the trust. It's firstly a good introduction from someone who's actually used a product and invested to someone else they trust. It's kind of increasing that trust network. So that's the way we're going. Yeah.
With regards to the percentage of men investors versus women, were you surprised that it was that high or low? Were you surprised there was that many women investors or not enough women investors?
Well, funny enough, because I've got I know some other people who have on the lending side some quite big lending platforms, P2P platforms, and they said to me, they're two different separate platforms. That was what they were seeing, and they said, they said mainly men and 40 to 70-year-old men. Fun enough, so I was surprised when they told me that. I was like, really? It seems kind of weird, but actually, so our results correlated with what they said. So that wasn't surprising, but I was surprised that is the case. It seems it's interesting in a way. It's just
Yeah, I think a lot of retirees and people that are in their 50s getting towards retirement age are looking at peer-to-peer lending and crowdfunding like a fixed income product, more like a bond in some ways, which is the way I never really considered it, because your capital, you hope, remains pretty level and even.
Yeah.
Maybe fluctuates a little bit, whereas if you buy a bond on the stock market, the chances are that the capital amount is fluctuating up and down. And so I think the older people like the idea of remaining level with their capital amount. So who knows, though? We'll see what happens. I do find it really surprising, too. I would have thought that it's technology, so it'll be a younger base of people, in their 20s, 25, who are more willing to take on more risk. But just goes to show you can never, ever tell.
Yeah, that's why actually before we launched our platform, we didn't want to use any people in terms of our marketing, because obviously people relate to people. So if you're guessing who's going to naturally like your platform and your product, you get it wrong, then you're kind of going off the wrong types of people.
Give me a brief synopsis, Fred, of where do you think the UK property market is going in the next 12 months? Do you see the Brexit situation affecting the property market in general, or for it just to remain as it is for now?
I think, it's interesting. It's why we're doing our model rather than just doing residential. Or I think, talk about the property market. You've got lots of different sectors, and I'm assuming you're talking about residential. But I'd say in the residential, I think in terms London is obviously completely different to any other city in the UK. I think high-end London is ridiculous, and that is completely being driven by I guess the currency at the moment, and then it was a lot of it's just foreign people kind of dumping money really, and I think that'll change. I think I wouldn't be surprised if that takes a big I've got friends in that business, and some of them say it's already taken a 30% hit. It's just there's not much liquidity in the market, so you don't really see it. But I think that's completely overpriced. I wouldn't be surprised if it comes off 30, 35, 40% even, to be honest. If you look at housing and residential and everything, there is black and white a huge housing shortage in the UK. It doesn't matter what goes on globally, that is still the case. And I think people also forget when we talk about the housing shortage in the UK, they forget it's not just linked to increasing population. It's also linked to, if you look at the family unit has changed in 30 years. So now many more people get divorced, many more young people move out earlier, want to live alone. So actually it's not just the numbers of people that is driving the housing demand. It's actually a change in the kind of family unit mix. If that makes sense. So I think that's just there, and there is a big demand and a need for housing. I think if you look at other subsectors, we all know some of them I would not personally invest in, like high street retail. If you go look around the UK at old market towns, walk down the high street. It's half empty or full of charity shops. It's dead. It's gone. So I think it's all a bit different. Every sector is a bit different and is reacting differently and affected by different things.
Yeah, I noticed that in my hometown of Poole.
Oh, really? Yeah.
We have a high street. Have you ever been to Poole before?
I haven't actually, no.
Okay. If you ever get a chance to go down there, there's not actually much in the downtown city centre of Poole, but there is a high street that the town was built around. And my dad owned a piece of commercial property down there, and I've noticed as the years have gone on how vacant the street has become. Everything, retail-wise is going to the internet nowadays, and that's the future, I think.
I agree.
I want you to put your unbiased hat on for me, Fred, for a second, and we're going to talk about risk. It's the biggest question that I get sent over on email from readers of the website, especially ones who have not invested before. They want to know how risky is peer-to-peer lending. So if we look at the alternative finance sector as a whole and looking at Brickowner, I want you to give me a number on the scale of 1 to 10. Where do you think, and 1 being the lowest, 10 being the highest risk, where do you think that Brickowner falls on that scale within the peer-to-peer lending and crowdfunding business?
I would say 3.
Okay.
I can justify it or explain it if you want.
Yeah, tell me why 3.
It's not going to be 1 because we are a newer, company. It is not. I would put ourselves below a lot of our competitors who are much, much bigger because of our model of, if you look at what can go wrong with investments, it's either the managers or it's also the products. And again, I would say, as I said, we're working with investing into assets managed by very established asset managers with a very strong track record. It's not just relying on our own new teams to manage. And we're not going for. I'm not into highly leveraged assets. And also, if you look at property in general, if we were only doing one asset class within property, I would say our risk would be higher than if we had our present model of of being able to go into industrial or residential, or because again, going back to the point we just mentioned of where do I see the market going in a good way, where we're able to adapt with the market, was some models, obviously they can't, they're only doing residential.
So number 3 on the risk scale. Thank you for being honest and unbiased. There is always an element of risk, and I think that gets lost when you're looking at crowdfunding and property investing, because you think property is very safe. But what I want people listening to understand, that there are inherent risks that come along with investing in property. Even if you're just buying your own properties, there is risk involved, and with equity investing, there is risk too. I wanted just to go back to talking about Brickowner's profitability taking 24 months. I noticed that on your website too, you advertise this, you have a Seeders campaign going on right now to raise equity. Can you tell me a little bit about how you're funded to be able to, get through the next 24 months without being profitable, and where has your funding come from, and what's going on with the Seeders? Is that your first Seeders?
No, it's our third, actually.
Oh, your third, okay.
Yeah, and it's part of a larger raise as well. So what we found is, I guess we're setting up a mass market business. So we like having as many investors as possible who are part of Brickowner, shareholders in Brickowner, then also using, I guess it's a whole kind of greater society mentality, also then using the platform. So that's where that's come from. But yeah, so far we've been funding the business in the same way all startups fund the business, either with our own money or with investors' money, and we foresee that happening in parallel with kind of our early now revenues, and as that increases, kind of less external funding, and being replaced with real revenues.
Right, and so you have enough funds to comfortably operate while you're not being profitable for the next 24 months.
Not today for the next 24 months, no. Because obviously, if we had it for... No, I don't think any company does. If we had it for 24 months today, we would probably have had to sell... As you know, with tech companies, your valuation changes. I mean, Uber raises money every 3 months. So your valuation shifts very rapidly. So it's not in our interest to be raising money for 18 months' time today. Okay.
How long do you tend to raise money for then, if you can give me an idea? Are you looking sort of a 6-month period?
12 months, yeah.
12 months, okay. So every, if you need to raise extra money, you just do it after a 12-month period.
Yeah.
Well, I guess you look at the bank account and go, maybe it's time.
Yeah, exactly. And maybe, according to the business model, so maybe you want to increase a marketing push for a bigger deal you're funding, or, if you're adding new features on, you want, it's not necessary to the core business model, but maybe you think it'll add on, it'll benefit in 18 months' time, so it'll take more money.
Yeah, and just for everybody listening out there, the reason why I ask these questions is because it's well known in startup business land that new companies do have a rather high failure rate. And these are just questions that I think have to be asked so we know what the stability of the company is like. Obviously, we hope that Brickowner does well, but these are the uncomfortable questions that have to be asked. And thank you for being honest about that, Fred. I appreciate your transparency. If you had an imaginary best friend, let's say his name was Stan, and Stan came to you and he said, Fred, I'm really interested in getting into equity, property investing, and peer-to-peer lending, but I really don't know how much of my liquid net worth is a comfortable amount for me to put in. I know that this varies from person to person depending on their situation, but let's take the average person. What would you tell Stan would be a comfortable level for him to put into alternative finance?
I guess, if he was spreading it between a number of different platforms, 25%, 30%.
Do you think 25 to 30 is a reasonable amount? Yeah, because I've had readers who've sent me emails saying they've got 50, 60, 70% of their liquid net worth into peer-to-peer lending, and I was a person that went through the 2008-2009 property crash, had a lot of cash of my own put in. Once you've been through an experience like that and taken a hit, everything becomes a lot more real.
Yeah.
And, I always urge people to really consider the possibility of what could happen if things do go wrong, having that much liquid net worth, and especially if they're older and they don't have enough time to recover from the hit. It's okay for a 20-year-old, 25-year-old. They have plenty of time to recover, but older people don't. So I like your answer, 20 to 25%. I think, personally I'm at about 15%. That's my comfortable level, but everybody is different, So,
Yeah.
And I think as time goes on and the sector becomes more established, that number could increase, but I think that's a good number.
Yeah.
Okay. So, wrapping up, Fred, sell me on Brickowner. There's a lot of alternatives out there. You've mentioned your business comes from a different perspective, as using asset managers, piggybacking off their experience, and being able to get into bigger deals maybe that some of the other property companies cannot get into. So there's that. Is there anything else that you'd like to share about maybe future plans, innovations, or products that investors might like to know about?
Yeah, so firstly we're going to open secondary market as well, so which will give us the ability to do deals which might have longer term lock-ins. So we're going to launch that, but probably later this year. And then we've been doing a lot of kind of listening to our users really, and we're kind of upgrading the platform, because as I said, we launched obviously beginning of the year. So since then we've been listening to our users, and we'll be making quite a number of changes to the visual side of the platform as well as the kind of the back end as well. Mm-hmm. But I think I view a platform really as kind of I don't know, like it's like a living thing. It's never really complete. You're always adding features, making changes. And I think that'll always happen, really, especially as I think over time your user base might, it'll become more mainstream. People will demand more features, or new things we haven't even thought of will probably kind of be required or be needed.
Is there anything else that you would like to discuss, or
I don't
covered everything?
I don't think so, really. No. Thanks a lot for making the time to speak.
Yeah, absolutely. So thank you, Fred, for coming and spending your time on the podcast today. For everybody listening, go take a look at Brickowner. I will put the link down in the description. See if that's something you think you might want to invest in. And we'll continue to keep an eye on the company and watch it grow and hopefully succeed and become a place where you can go and get all your property investing needs met. So thanks again, Fred, and good luck to you.
Thanks a lot, Lawrence. Thanks. Sounds good. Brilliant. Thanks.
You've been listening to the Financial Thing Peer-to-Peer Lending Essentials podcast. Don't forget to visit financialthing.com for all the latest peer-to-peer lending reviews and DIY investing articles.